If you rewind the clock back to the 19th and early 20th centuries, buying a stock hoping its price would simply go up was considered a highly speculative, slightly disreputable gamble. Serious investors back then bought stocks for the specific income they generated. They demanded that companies distribute their actual cash profits to shareholders, exactly the way a landlord collects and distributes rental income from a physical property. That income-first philosophy produced an elite class of businesses we now call dividend aristocrats and dividend kings. These are companies that have raised their dividend payments every single year for 25 to over 50 consecutive years, treating that cash distribution as a sacred corporate commitment. That historical inheritance shaped how millions of Americans still view the stock market today. It ingrained a deeply held cultural belief that a dividend payout functions as a reliable extra salary that rewards you simply for holding the shares. But the academic finance community views that belief as a complete mathematical illusion. In 1961, economists Merton Miller and Franco Modigliani published a theorem proving that in a perfectly frictionless market, dividends are entirely irrelevant to an investor's overall wealth. This equation shows exactly what happens mechanically on what is called the ex-dividend date. When a company formally pays out cash, that cash leaves the corporate balance sheet. As a result, the stock market instantly adjusts the company's share price downward by the exact amount of the dividend. You receive $2 in cash, but your stock shares are instantly worth $2 less. The transaction leaves you with a net wealth change of exactly zero. If the academics are right, if a dividend is really just moving money from your left pocket to your right pocket, it leaves us with a massive unanswered question. Why does this approach remain a cornerstone of so many investment portfolios? The discrepancy exists because academic models assume a perfectly frictionless world, populated by completely rational calculators. They do not account for the messy, emotional reality of human psychology. When a retiree relies purely on stock price appreciation to survive, they are forced to actively sell off chunks of their portfolio to pay their bills. That process requires making constant, anxiety-inducing decisions about which shares to liquidate, while watching the total number of shares they own permanently shrink. Dividends provide you with income without selling. The cash arrives automatically in the brokerage account on specific quarterly dates. It gives investors the psychological security of spending the portfolio's output without ever having to chop away at the underlying principal. This chart shows a market crashing 40%, illustrating how automatic income prevents the most destructive investor behavior, panic selling. The growth investor, watching their total wealth plummet, liquidates out of fear at the absolute bottom. The dividend investor holds their ground because they can clearly see the steady pulse of cash continuing to hit their account. The dividend acts as a vital behavioral anchor. It tricks human psychology into doing the mathematically correct thing by framing a severe market downturn as an opportunity to buy more shares on sale while the income stream remains completely intact. This bar chart compares a normal 3% yield to a 10% yield, highlighting the single most common trap for new investors. Yield is calculated by dividing the annual dividend by the stock price. When you see a massive yield spike, it almost always means the underlying stock price has collapsed and the market expects the dividend to be cut entirely. To spot these yield traps, experienced investors use the free cash flow payout ratio. This is the total dividends paid out, divided by the actual cash the business generates after paying for its operating and capital expenses. If that ratio creeps over 100%, the company is literally draining cash reserves or taking on debt just to maintain the payout. Instead of chasing high starting yields, successful long-term investors focus on dividend growth. They look for businesses with durable competitive advantages that have proven their ability to steadily increase their cash distributions through multiple recessions and economic cycles. During an investor's accumulation years, they take those growing dividends and feed them into a DRIP, a dividend reinvestment plan. This automatically uses every cash payment to buy fractional shares of the same stock, which then pay their own dividends, creating an aggressive compounding loop. Over 20 or 30 years, this loop drives up your yield on cost, the annual dividend payout measured against your original purchase price. A small initial investment slowly transforms into a massive income engine, paying out annual dividends that rival the total cash you originally used to buy the stock. But executing this properly requires navigating one final, mathematically verified critique from the academic side: the severe impact of tax drag. Every time a dividend hits a taxable account, the IRS forces you to recognize that income, whether you actually plan to spend it or not. Not all of these payouts are taxed equally. Qualified dividends from standard U.S. corporations benefit from lower, long-term capital gains rates. Ordinary dividends, like those from real estate investment trusts, are taxed at your standard marginal income tax rate, which rapidly eats into your returns. Protecting your wealth requires asset location optimization. This means deliberately mapping your investments to specific account types, making sure high-yielding ordinary dividend payers are heavily shielded inside tax-advantaged accounts like IRAs or 401ks. Here is a pie chart constructing a reliable, real-world portfolio for a retiree needing immediate cash flow. Ultimately, dividend investing functions in stable dividend aristocrats: 20 to 25% in defensive utilities, 15 to 20% in REITs placed in tax-advantaged accounts, and the final 10 to 15% in bonds to dampen volatility. A younger investor with decades until retirement would structure this entirely differently. They would bypass the higher initial yields of utilities and REITs, heavily prioritizing the lower-yielding, aggressive dividend growth found in major technology and financial institutions. Ultimately, dividend investing functions as a mechanical behavioral tool. The strategy provides the psychological discipline to stay invested through the market's worst moments, which is the only way to reach actual financial independence.